Now, be it winter or summer or monsoon, fashion never sleeps though. But the struggle to stay in vogue is real and the competition is cutthroat. So what does it really take to be one of the fastest growing fashion retailers in the country? And what would it take V2 Retail to move from where it is to where it can be? Let's find that out from Akash Agarwal. He's director at V2 Retail, joins us right now on the show. Akash, good having you. Thanks so much for joining in. You've come a long way from where you were to where you are. What's the projections for FY19?
Yeah, so currently we're operating 57 stores. We've opened 8 new stores this quarter, and we plan to open another 6 to 7 stores this month. And we should close the year at around 1.1 million square feet and a store count of 100 stores, and looking at a turnover of around 900 crores with an EBITDA margin of 10%.
Interesting. In various maybe calls or conversations with brokerages, you've spoken about the store count as likely to be about 125 odd by FY20. In million square feet, what do you expect FY20 to look like? And is there a change in the geographical patterns in where your expansions are taking place?
So the projections I'm giving you is for FY19. So we are looking to close FY19 and touch the 100 store mark by the end of this financial year. And by FY20, I think we should be able to open another 50 stores and reach the store count 150 stores.
Wow, that's interesting. What does that take your area under management to like? Because I mean, I must tell you, so FY19, I think most people, or at least the brokerages that we've read, are in line with the guidance that you're giving, Akash. But FY20, you're sounding a lot more ambitious right now than what people are factoring in. Where does that optimism come from? And I'm very happy for that, of course. But where does the optimism come from? And what would be I repeat my question, what would be the area under management for you if you indeed do manage about 150 by the end of FY20?
So the area under management by FY20 should be around 1.6 to 1.7 million square feet. And the optimism comes because we have 90 crores of cash on our books already, and we would do an EBITDA of around 90 crores this year. So I think we have ample capital for expansion. And it all depends on the execution. So if we feel that whatever stores we open this year and all the processes that we have defined is executed well, then I think shouldn't be a problem by growing at another 50% next year.
Okay. I reckon you wouldn't need to raise any kind of debt or even further equity fundraising to fund this expansion. Internal accruals and the cash on books should be enough to do this?
Yes, definitely. I feel that the cash on the books and the future EBITDA and the cash flows that we'll make should be enough for the expansion in the next 2 years. So we're not looking for any debt or equity expansion.
Interesting. What's happening? I mean, the one is the quantum of stores that a retail company would open. Second would be the change, or if there is a change, of course, but the change in the kind of products and the retail strategy that the company is adopting. Now, you guys have moved through the crests and the troughs in the last 10 odd years. How is the strategy right now different from what used to be? And what's the strategy for the next 2 years with this aggressive store count that you're talking about?
So a lot of our focus is on product development and private labels now. So currently my private label contribution is only 15% of the total business, and we're looking to take it up to at least 30-35% in the next 12 to 18 months. So that is one big area of focus. And obviously we are always trying to improve our assortment and the range assortment, the color assortment, the size standardization. So basically we are focusing a lot on product so that the customer gets the better offering, and that creates a differentiation from our competitors, because the competition intensity is increasing in the market. So we need to do something innovative and new to attract more customers. So I think the whole differentiation would be product driven, supported with good investment in technology and SOPs, processes, and investing in the right kind of people and getting the right kind of training in place so that everything is executed well. Because we're trying to build a base now on which we can do a growth of about 40 to 50% every year.
Yeah, and would all just tell me, would all of your growth, at least in terms of the store count, would come in areas where you are currently present and in and around there, or are you looking to expand into areas where you hitherto don't have any presence at all?
So we are expanding into new areas because we in our future plans have that we should open around 1,000 stores in the next 5 years. So we need to be present all over the country. So we are experimenting with new regions. So we have finalized a store in the south, we finalized a store in Goa, we finalized a store in Jammu and Kashmir, and we finalized a store in Rajasthan. So we're going in all directions, and whichever region we are new in, we're approaching with a cluster-based approach so that it helps us with our logistics and our supply chain. But yes, there's no focus on a specific region. We're going on all 4 parts of the country.
Interesting. My final question really is on, one, the profitability, and 2, the return ratios. Now, the expectations across the analyst community is that both your EBITDA margins will scale up meaningfully. I mean, meaningfully for the kind of business that retail is. And 2, your return ratios, I think the expectations are that there will be a dramatic uptick in your return ratios come FY20, FY21. 1, would you believe that to be the case? And 2, if so, what would be the factors that would lead to that?
So as we have already built a base, we've hired a lot of new management personnel. So I think when we have a larger base and when we operate more retail area, so our costs should come down significantly, which should have a positive effect on our EBITDA margins. And talking about return ratios, again, I would say it's all about executing it well and the kind of sales per square feet that we get from our new stores. So we have a positive outlook, and if we meet our internal targets, I think we should be able to expand our EBITDA margin to 11%, which would lead to a better return ratio by FY20.
Okay. Great. Good having you, Akash. Thank you so much for taking the time out and speaking with us and giving us your thoughts. Remember, a clutch of brokerages are very bullish on this one. MK, for example, believes that the 12-month target price of MK is about 590. They believe there is a 54% upside, or 50% upside, let's put it that way, to V2 retail from where it is currently. It anyways trades at a steep discount to its peers, and there is a likelihood of that discount narrowing over a period of time, which is why these guys are bullish, and the management commentary a lot more confident than what the analysts had penciled in as well. Do watch out for V2 retail.